So I think we can begin now. Good afternoon, everyone. My name is Shuchi Bhatnagar, and I will be a moderator today for what promises to be a very exciting session about P2P lending. P2P lending in India has been experiencing rapid growth, emerging as a stable, high-return asset class. Our aim today is to understand from our experts how we can capitalize on this fast expanding sector. We have with us Mr. Saurabh Kulkarni, who has been a P2P lender since 2018. He is one of our largest lenders who also invests on behalf of many of his family members through our household account. Mr. Kulkarni is the CEO and the founder of Esteemed Financial Services, which oversees a large amount of HNI wealth and has expertise across asset classes. Many of his clients have diversified their portfolio to include P2P lending in order to earn higher returns. Welcome, Mr. Kulkarni.
Yeah, hi. Thanks for having me.
Our second expert needs no introduction. An industry veteran, Vinay Matthews is founder and COO of Faircent.com. His 25 years of experience in scaling up operations and delivering profitable growth for internet businesses has helped him establish Faircent as India's largest and also the first RBI certified NBFC P2P. Welcome, Vinay.
Hey, thanks, Suchi. That was one of the best introductions that I've got. Thank you so much.
Before we begin, we have a small poll for all of you today. On your screen, you will see a question which will be there for the next 30 seconds. Please answer by just clicking on the option that you want. So it's, can you guys see it? The question is right now over there. It's, are you a P2P lender or not? And you have to choose between a yes and a no. That's it. Yes, so almost everybody has voted. Just a couple of more votes to go. And it seems predominantly the audience today is a P2P lender already. We have about more than 70% people who have already invested in P2P and are P2P lenders. So that should make this an even more interesting experience.
Yeah.
So let's begin. So Vinay, we'll start with you. Faircent is a pioneer of P2P lending in India. In 2013, when you established Faircent, not many people had even heard of the concept in India. What made you introduce P2P lending and launch Faircent.com?
Me and my partner, Rajat, were talking about to start something for quite some time. We were not from the financial services background. We were more from the technology, internet background. So we've dealt with large organizations, internet businesses, and that's where we learned all the tricks and trades and all of that to run a platform like this, which is a two-sided marketplace platform. So I think 2011 onwards, we started talking about it, and 2013 is when the company got incorporated, and Rajat took the plunge. And post that, I think 2014, I also quit my job and I got into this full time. So during that time, I think we were the first one to kind of start a P2P business, P2P lending business. Also, the word fintech was not coined back then. That was the time when we started our journey. So, so the journey has been quite interesting. And one of the reasons that we thought of getting into this business was because, and we wanted to kind of, at least I wanted to get into something which was really big and was, had a pressing need. Okay, so clearly this business had a real pressing need. Lots and lots of people were, credit starved or were, unserved in this country. So that one clear need was there. And two, I think this was too big a sector to kind of not get into. It's too tempting, So in my career, I got even more excited. It was more exciting than e-commerce, So let me put it like that. So I think that is the reason, I thought that we should get into this and try and make it big. So, Mr. Kulkarni, it's so nice to see you.
Same here.
Yeah. So, I hope everything is okay at your end, family-wise, health-wise, everything is fine.
Yeah. Everything is nice. Yeah.
It's an honor to kind of have you, and you've been one of the torch bearers of P2P lending industry in this country. I may want to qualify that. The kind of commitment and the kind of the entire scope in which you look at this. At least I have got a lot of learning from you, based on the discussion and conversations we've had whenever I've met you, and over the telephone calls that we've had subsequently, once a week or once in 15 days. So the learnings that you shared with me, sometimes I feel that the financial services learning is so important, to run this business as well. So I think a whole lot of it is something, that, your learning helped. So the principle remains the same, but I think the whole concept of, how to invest, where to invest, and I'm going to pick your brains on that today. And that's what this conversation is all about. I think want to understand from you and want all the users connected today. What is it? What is it that, when you started considering P2P, as a lending, as an option to invest, and how has been your experience, till now, investing on platforms which are available?
Thanks, Vinay, for those kind words. The honor is equally mine. So I think I believe I started in 2018. So we have been active investors in stock market, in various other asset classes, and I wanted to find something which is much less correlated to the economy. So there is this one, interest rates. If the interest rates go down, generally the stock markets go up. The fixed income also does well. Then there's gold, which can be sometimes inversely correlated. But we wanted to have something which is not at all correlated, as much as possible, as much as feasible, to our traditional asset investments. Now, B2P stood out in that. And then we started realizing that this is more like a sunrise sector. So if we get involved at this stage, we can possibly make much higher returns. Now, talking about my experience, yes, we have been able to generate those kind of non-correlated high returns.
Mm-hmm. Okay. And and what do you think? Well, I just want to understand. Okay, you heard about P2P and you just started, or you just kind of try to figure out what it is, or try to understand this better, and then got into it.
That was never easy. You are yourself witnessed the kind of due diligence that we had to do, the amount of questions that we had to ask you. So we did a lot of due diligence on this industry, not only in India but abroad. Then we tried to study that what makes our Indian context unique. So when we studied you, when we met you, we realized that this was a company where the business model is has been validated, because you raised money pretty early. I believe in 2015 was the first when you had your seed round. Then you had your Series A. Then 2016 we had the same investors following up. So the same investors following up, and there were a few additional investors. Then we again had this Series C in 2019. Which means that we knew that this is a player which has got runway. This is a player which has got a business model which is validated by the doyens of the industry, by those who look at this industry very closely. Secondly, we also looked at the amount of investments that you did in the technology, because that is the core of the business. The heart of the business is not just about the people, but about the technology, not about the branch network, not about the physical presence. So that we understood, and what we really liked about it was that most of the things that we did in our previous business were so much skill based. We wanted to have something which is rule based and less skill based, so that we don't have to depend on one star performer. So P2P is more like, from my point of view, this is more like a quant trading. So when we trade in futures, when we trade in stocks, we do a little bit of mix and match between algos and manual. But P2P is, the entire process is automated. So the way you validate the borrower, the way you assess his creditworthiness, the way you predict, and the entire underwriting process, the entire the delivery of loan collection, as much as possible, it has been automated. So this is what got us interested, and we wanted to. So we were very sure that if we get in with the right people, we can take it to a very large level. And I want to mention on this platform that what we have done so far just represents a fraction of what we are capable of doing.
Yeah, absolutely.
We want to take it to a much larger level than this.
Yeah. No, yeah. So let me expand that a little bit on the point that you mentioned. I think we've always been an organization which wanted to kind of understand data. Okay, and believe me or not, data do not lie. Okay?
Correct.
Simple data point: if you're standing on a weighing machine, and if it is suggesting something, it is giving you a feedback. All right. So that data point is what you have to go to work with or go to work on. So you cannot completely take that away. So the data is a very, very important, a critical piece in our journey. So from the beginning itself, I think we were very, very focused around data, because when we started, we had some parameters, we had certain rules, basis which we started our journey. Okay, it was more of a you can say borrowed rules and data points or weightages from the industry, right? So when we started our journey, so there were some 30 parameters that we started with certain weightages. And as we move forward, the parameters increased. Today 30 parameters has increased to 120 parameters. The weightages have gone, a whole lot of changes. Okay, so there were a lot of data points that people were talking about, which didn't have, it was more of an anecdotal data. It was not a data which was, proven, from a large sample point of view. For example, one of the data points that we used to keep getting during our journey was, women are better borrower than men. Okay, maybe it's true, but and a lot of lenders were interested in picking women borrowers. Okay, till we realized that as we scale, we realized that women are equally delinquent like men. So there is no major difference between the ratio in which the women and men are getting going bad. So then when we dug data deeper to realize that more women. Women used to kind of take money for their men. Okay, there you are. So you could not get that information till the time you understood that the money is to be for the use of women, not for the giving it to men. So we started kind of putting some rules around that as well to make sure that the money is going to the women, so that the prediction is not going around just because the money is going in different hands. So data has always been a critical thing, and this is what we always do. We go back to these rules, we kind of tighten them, we kind of introduce new parameters, we add weightages, we reduce weightages, and all of that. These 120 parameters go through a lot of and every quarter it goes through a lot of changes. So now that what we have done is during this time that we are seeing. So what we've done is that we started making combinations of these parameters, right? So we're using machine learning to kind of make combinations of these various parameters. Okay, so age and CIBIL score and house status would be one parameter. Let's say similarly there are multiple combinations we make, and those parameters now has got into some 1,000 to 2,000 data points. So now the data goes through these 1,000 points or 2,000 points, and by which the prediction happens. So the whole idea is to kind of accurately predict and not to leave anything by anecdotal or by chance or by gut or by any of the intelligence that anybody is trying to use. It's just pure data.
There's also this huge explosion in alternate data, meaning the usage of smartphones or the satellite imaging. So all this alternate data is very difficult for a traditional lender which already has got a huge infrastructure to adapt. So it's not like you should use this also. You should be basing your decision only on this. Then only the predictions can be sacrosanct. Then only you will have a more consistent results or a risk-adjusted better returns.
I agree. So I think one of the points that in my previous webinar was that going forward, I think organizations have to use outside data to kind of conduct business, not just data which they capture within themselves for their business, but have to have outside information, a lot of data which makes sense for your set of customers, you need to kind of have that going, because we've seen that, during COVID times, because we were able to capture PIN codes, we used government data, the green, red, and amber data zones, and we relate that to our lenders, saying that this particular borrower is from green zone, this particular borrower is from red zone. So the customer is able to kind of make a decision. So this place is not impacted by COVID a lot. Let me invest. So basically synthesizing the external information or external data to kind of make a decision for our lenders. Yeah, absolutely. A lot of that data is now being used for verification and validation also, the outside data. You're right. Yeah. A lot of people have opened up the data also.
Yeah. It also means that we are now, so we are just, the trend was there anyway. Now this is going to accelerate, move towards digital.
Yes. So COVID has, in fact, accelerated the, journey. And yes, and not just for us, for everybody, even the traditional banks and NBFCs, all of them are looking at, now technology to kind of, take them to the next level, because you can't do it otherwise. Okay. So now that we have got a huge advantage in terms of, how to go from here, I think we are poised better to kind of, leapfrog that growth. Okay? So let me just, give you some of the things that, we did during this time. So one of the things that we did was, for example, verification. Okay. So earlier verification somebody used to go figure out where you live, understand all of that. Okay. Today we are doing this through WhatsApp, through a video call. We are practically getting into that individual's house, inside his house, which was not possible during COVID time. Nobody would entertain you, getting into your house. So you do that through technology. Ask him to kind of move around his house, figure out his assets, figure out how his financial situation is. All of that you can figure out by moving him around the house, and then ask him to get out of step out of his house, show his house number, all of that. So that's verification, new form, new avatar, and all of that. So those things are organizations. A lot of organizations are kind of trying to do that to make sure that the navigation it's smoother and better as we go along. And that's one of them. There are lots and lots of things that we've done in the last 4 or 5 months. But I want to ask you. So I've been talking about me. What we've been doing. But I want to ask you, what is more important? Do you think any asset class, if you look at India as a country, any asset class takes 15, 20, sometimes even 30 years to kind of establish, right? From an Indian context. So do you think how would P2P lending evolve? Do you think wealth advisors should recommend their client?
Yeah.
Do you think it should have a must-have portfolio? What is your opinion in terms of does it help, really help? I'm just wanting to ask this honestly. Does it really help clients build more stable portfolio during this current crisis?
Yeah, I would definitely feel so. Less so, not just because of the returns. That is one of the aspects. But I think what has happened in our country, to address your first question, the earlier question, is that what has happened in our country is that most of the trends which have been there in the West are being adopted over here, but the pace has been much different. So, for example, it took a lot of time for Amazon to establish or to dominate in US. But we had a Flipkart which was not known until 2010 and which got acquired for $50 billion in 2015. So we had a company which goes from $0 to $50 billion in 5 years because the need was much higher. So when I look at this economy, and again there's a social aspect to it. So when I look at Indian economy, the amount of or the number of individuals, SMEs, which are credit starved for no fault of theirs, the number of banks whose balance sheets are damaged in a way beyond repair, and then this presents this massive opportunity. So we have this two-way marketplace where there are lenders who are starved for yield, who don't have enough opportunities, especially the mid-income mass scale. So although we deal mostly with the HNI segment, but even the mid-income ones are so they are not. It's not very easy for them to participate into an AIF or into a private equity fund or into a real estate fund, even if the cycle were in the right direction. So they don't have any other option, in my opinion, than to invest in a P2P type asset, which is regulated. One, second, which is transparent, which means that you get to know where your money is going. You have a different custodian. The money doesn't go to the platform. There is a lot of choice in terms of what type of strategy, time frame, risk he has to adopt, which is the people like us come into picture, that we try to match it to his risk profile. We try to match it with the economic outlook that we have. So we would want to be a little bit conservative in times like this. And we'll want to be a bit aggressive, especially with short tenure loans in good times. So basically, we will. I don't see. This is my personal view, but I don't see Indian P2P from here on taking that much time. The amount of time which has been spent since 2005, if I'm right, this industry started in 2005 formally with the likes of Zopa and Virgin Money. And then we have a lending club, I think, which is the biggest P2P platform in the world, which is about 10 billion plus. So so $100 billion industry in US, we don't necessarily have to restrict ourselves to that number. So if I look at this originations of personal loans, unsecured loans, then every month it's almost equivalent or slightly more than the SIP book of the entire industry. So entire industry does equity SIP. Just to compare two distinct numbers, entire industry does equity SIP or general SIP of 8,000-9,000 crores, just above $1 billion. And we have top two NBFCs and HDFC Bank combined doing 15,000 crores of personal loans per month. Now that's the scope. So if we are going to deliver, so because we are dealing with unsecured loans, because we are delivering a consistent user experience, I think that's the scope. That we'll soon have platforms which do, instead of 100 CR a month, we can have platforms which can do 1,000 crores a month, and we can have borrowers which are serviced, and both ways. I mean, because this is a two-way platform, we don't need the traditional model of permanent capital.
Correct. You're absolutely right.
So I'm hoping that this happens much sooner than going through the standard time frame, because we have to also consider that when this mutual fund industry took off, this product didn't have the prowess of social media. In the initial, it didn't have the
True. Yeah. So the technology leaps, in a completely different way. You're absolutely right. So most of the technology companies that you see, which is scaled out in India, has not taken more than 10 years, or at best 10 years. Okay, in 10 years we've delivered. Okay, so from that point of view, a couple of years back the regulation came. So we're talking about good 5-7 years at best. 5-7 years, this will be completely a different animal.
Correct.
So I think from that point of view, and also there is a very unique thing about a two-sided marketplace. Is that you see any category, be it shopping, be it travel, be it cab booking or whatever, you won't find more than 3 or 4 or 5 players, right? And that's because the nature of the technology is such that it kind of occupies a large number of market share. A large market share the market leader takes away, so it's very little which is left for others to kind of take. So and if the journey continues like that without any major screw up, I think it keeps adding more and more market share. So that's how these technology companies work. So from that point of view, I think you're absolutely right. Technology will leapfrog this to completely new level very soon. Faster than what other paths would have taken.
Yeah.
I also wanted to understand this from you. Okay, so. Tell me, when you are doing this, P2P investment for your clients, is there a math that you look at that So one way is to kind of do say that I allocate this much to equity, this much to kind of bonds, and this much to fixed deposits or whatever, and this much to P2P. Okay. So what is your math? What is how you look at it? From your point of view, how does it?
This is part of an alternate asset allocation for me. This is a part of an alternate asset allocation. So typically 10% will be a decent number. However, it's also a function of whether we see a very good opportunity in fixed income. So I would
one second, hold on. So why 10%? Why not 5%? Why not 15%? That's the question, actually.
Okay. Mostly because most of my clients are younger HNIs. Or HNIs in their 50s, which means that they have a lot of earnings, a lot of years left. Which means that if there's an asset class where I can lock in 10-15% returns, depending upon when I enter, I would not mind having 10-15% even, because new money is coming. So we have been fortunate that we are dealing almost exclusively with the HNI crowd, which means that no one will be strapped for cash. So that's why we never. That's why we are not very. And secondly, we don't have real estate. For a long time, we have never had real estate. which means that we have that illiquid pocket open. So we have that part of allocation open, which P2P can occupy.
Okay. All right. So do you think that from an attraction point of view, within the asset classes that you have, here is an asset class which is not as volatile as the other asset class, like a stock market.
That is the key.
Okay. Yeah, that is one. Second is that it is not very, very capital intensive, like real estate, though
Absolutely.
you have that.
Absolutely.
So that is one benefit. Second is that, this is the only investment which gets you money coming to you every month, right? So there is a EMI which comes to you every month. So the liquidity, from a liquidity point of view, also it's kind of
Not that bad. Correct.
pretty good.
If
Either
you are
you can
investing,
reinvest or you can use it for some
Yeah.
of your other purpose or whatever. So
correct.
so from that point of view, you think this is very attractive, and as we move forward, the structure may currently maybe a little restrictive, but structure may change. The government will have a different view on this. Maybe we'll be able to kind of offer secured loans. I don't know. So maybe as we go along, do you think this will be an attractive investment opportunity?
I would think so.
Okay.
The key the key is that the approach that a wealth, because I remember you had mentioned this question which slipped my mind, which is about how should a wealth advisor approach this. Now I'll tell you the problem with wealth advisors today, that they view this product more as an investment product, but this is an investment product which is embedded into a tech product. So when they look at this as a technology, then they will try to believe it more, rather than looking at, because then when you talk about this as an investment product, then all these questions about this being an unsecured product, this concept being very new, the companies or the platforms involved are being very startup stage. These are the questions which come to investors' mind, and those are the questions which I believe most of the wealth managers themselves are struggling with.
Oh, interesting.
Yeah. So I don't have to think too much about this is a financial product, so we can't have the same amount of disconnect the way I am when I'm ordering from an aggregator.
Mm-hmm.
So I cannot. It's not like ordering a food item from Swiggy or something. So it's a little bit more serious stuff. But when I'm lending very small amounts to a large number of borrowers, which have been selected based on some data science, which have been selected based on big data, which have been selected based on some rules where human intervention has been minimal, and basically this is an individual loan. So are we not? So that's a question. Are we not talking enough about the fact that loaning money to corporates, loaning money to business is a different concept legally than loaning money to individuals, because at the end of the day, it is his liability. So unless he is totally out of business, out of work, this money is not going to be this loan is not going to be defaulted on completely. So the chances of losing your money completely or someone running with your money is much less over here than let's say even in a secured paper.
Yeah.
So when that realization comes, then we will have a lot of normal folks, ordinary folks who will be allocating money to P2P. Because what surprises me, I mean, maybe a little bit off track, but what surprises me is that the emergence of Robinhood in America, or the addition of a crore traders, some 10 lakh traders in 2 single months, in 2 consecutive months, with the likes of Zerodha and Angel Broker. So how come individuals in this country feel that they can take control and they can trade stock markets, which most of the professionals are struggling with today, but the same individuals are not willing to trust a platform with a lack of rules? Now that's a dichotomy. That's a disconnect because there's lack of understanding.
Got it. Interesting. So seems that you have to look at it in a different way to kind of understand this is an attractive investment. So I have a poll here, so she asked me to kind of take this poll. So I'll just put this poll out for our users for a quick whatever answer that you want to give. So it's a poll on what attracts you most to P2P lending. So I'm launching this poll. We'll get a couple of minutes to answer this, and after that we'll close this. Here you go. It's there on your screen. You can start voting it. So I think, Mr. Kulkarni, diversifying your portfolio has a very strong, weightage there.
Okay.
People want to diversify the portfolio. That's the reason they invest in P2P lending, which is very, very interesting. Okay, so I think, and this is what we've always been saying. We want people to kind of, invest to diversify the portfolio, because this is not a very risky in terms of volatility portfolio, and I'll just touch upon the point that you mentioned. Individuals typically are committed to kind of pay. Okay, so unlike, and also they're very transparent. Individuals are more transparent than organizations or institutions, which kind of have a lot of ways and means to kind of keep them like that, or they are told to be kept like that till they are listed, right? So so I think if you take a lot of data point from the individual, I think you're pretty much good in terms of trying to kind of make the individual pay back again, or pay back on time. So, and also this entire thought of the people who will not pay back is also something which people have to understand. A lot of people think that if I invest in somebody, he's not going to pay back. So there is a lot of intelligence which is being used to intelligence which is being used to get this borrower on our platform. A lot of data, a lot of science is used to get the person on the platform. And second point is that once that validation has happened, there is a crowd intelligence which is used to kind of pick up that borrower again. So if the crowd feels that the borrower is not good, so there are many cases that they go unfunded as well. Okay? But having said that, here's what I feel. Okay, if you give out money to a large number of people, let's say you walk into an organization and give out money to a large number of people, the people who are working in that organization, chances are that, and without doing any data crunching, no science, nothing, chances are 20% of the people will pay you back. Okay, 30% will not pay you back. Well, if it depends on the organization you walk in. So if you walk into let's say a domestic call center, maybe 40% may not pay you back. Okay, and if you walk into a good, maybe a Google or a Facebook or a HLL or some large organization, you may have maybe 90% of people pay you back. Okay, randomly you give money, right? So this research has been done in many countries, including India. So the whole science is built around figuring out how you can bridge this 30% or 10% or whatever. Okay, so you put a collection team in place, you use technology and all of that intervention, you can get to that 4-5%, in that range. So we get a collection, done this month. It was in fact one of the best, 97% collection in 0 to 30 days. So it was absolutely a stunner, So basically you're talking about those 5%, or thereabouts, 3%, 5%, 6%. The entire underwriting models are based.
Yeah.
So for me, I think this is how it is. आम आदमी का जो फितरत होता है ना, वो खराब नहीं होता है. Okay? A common man, an honest man. Okay, he gets up in the morning and he wants to work, and provide for his family, or make his career better. All of that is there. Okay, regular people are like that. Okay, there will be a very few set of people who will try to kind of fib or game the system, right? So in the last 6 years, at least, we have kind of figured out ways and mechanisms to kind of make sure that those kind of people do not enter our platform. Okay.
Yeah.
So the gaming part is completely out of question now, because we look at data in a very, very different way from when we started. Okay, and there are cross validations which happens across different integrations that we have. Okay, so we don't rely on what he gives, we validate it with third parties, to kind of figure out what the guy is saying is right or not. Okay, so from that point of view, I believe that most of them want to pay back. As you rightly pointed out, they want to pay back. It's just that if someone slows down, it may be because of some circumstances. So for example, currently, we are getting good customers right now. Okay, and we are very bullish about putting these customers out. But and we don't know really, if you ask me, whether they're going to lose the job in future or not. But we believe that these customers are solid customers, right? So working in good MNCs, good organizations, good pays, all of that is good. Even if they lose the job, okay, the chances are they'll get a job, another job, very soon in a couple of months. That is the only thing that drives us, and the reason is that when I said aam aadmi ki fitrat kharab nahi hoti hai, everybody is has a fear of God and law. I really mean it. For example, in a red light also, if there are without a cop standing there, 100 people go and stand in the red light, they all respect the red light. So very few people kind of pop out. Okay, and that's where the laws are for. And same as with lending. So there are laws, there are rules. So the entire prism is not to be looked at 2-3% default. So how about those 95% people who are paying on time, right? So that's the prism you should look at and invest. You're absolutely right there.
But has it changed in any way post-COVID? So do you believe that if I were to get this normal distribution, then if I don't want to get affected by this 2%, then I need to be investing slightly more, or I need to be investing in slightly more number of borrowers?
Yes. So I'll tell you what. So COVID has taught us, a few things. Apart from demand supply, change that we've had. So for example, we're getting more, better demand from what we were getting earlier, because the banks and the NBFCs have slowed down, right? So that demand supply equation has changed a little bit. Also, we're very careful about what's the demand we want to put out, right? Because it's important to kind of realize that it should not be a situation that the demand is going to be irrelevant, or that particular profile or that borrower is going to be irrelevant going forward. So it's important for us to kind of realize that some of the jobs may get irrelevant. So and if he's a little senior, fellow, it's even more difficult for him to kind of get another job. So we have to be very careful about those things. Apart from that, I talked about the verification, the way we are assessing kind of has changed. We're using a lot of technology and information to kind of figure out and understand. On the risk philosophy, we have on the risk side, we have tightened the rules. Entry has been restricted to only people who are 700 plus. So all of that we have done. But the interesting thing is that we have done a lot on the operations and the collection side, right? So that is something I want to kind of tell you. Maybe we never got a chance to kind of tell that. Sorry.
So that was about to be my next question. So please.
So that's one question that so that was something that I always wanted to kind of talk to you about, which always whenever we spoke skipped. So what we are doing is that we are looking at to kind of obviously we were automating all of this from the very beginning. So all the automated mails, SMS, all of that used to go to these borrowers. Automated calls and all that anyways was there, right? So, and then manual calling was happening, chasing off these borrowers are not paying on time was happening. So what we did recently was, I'll tell you what. So one, we tried and prioritized the borrowers, right? So who are the ones we should go after first? And one of the way we prioritize is to kind of understand how much money is taken from the platform and how many lenders are getting impacted with that, right? So that is one. So more value and more impact, gets a priority. Okay, that is one. Second, we're looking at this data. We're looking at customers who are not paying, scrubbing their data on our system. Scrubbing the data on bureau, credit bureau agencies. So credit bureau agencies have the service where you give them the data. They will give you information about the customers, whether they're paying on time or not. So, for example, the ones who are not paying us, okay, if we scrub their data to understand, are they paying others? If they're taking loan from other organizations, are they paying them? Or is it that they're not paying us and paying others? Or is it that they are paying us and not paying others because of the pressure that we are putting? Okay. So anyways, either ways, there is a priority to be set there. Okay. So that is the other thing that we do. Also, what we've also done is that we have enhanced our skip tracing. Okay. So there is a lot of skip tracing that we do. This is primarily to kind of the challenge that we face is that the borrower disappears. He kind of moves out of the city. He moves out of, he changes his telephone number, the address, everything is changed, right? So now it's difficult to kind of, find the guy. So you have to kind of figure out how to kind of, get hold of this guy. So one of the ways that, we used to do that was to go to Naukri or LinkedIn or any of those, websites where he would have updated his resume or updated his profile, right? Just to be relevant, or just to be kind of, make sure that whoever the next job that he's going to take, the person knows that he's working currently in this organization. So we'll get to know the organization that he's working for. Okay? Second thing that we did was that we have tied up with EPF. Okay, EPF where we get real-time data in terms of if he's moved from one organization and went to join another organization. We can pull the EPF data of this particular customer because he got in, using that information of his last organization. So by the way, when we onboard a customer, we look at that data, right? So,
yeah.
so if the
that
EPF comes
to understand whether he has put his salary correctly. With that,
yeah, salary imputation also happens through that. You're absolutely right. So if he's, now the EPF is coming out of Bangalore of a different company, you get to know the company's name. So that is another skip tracing mechanism. The other thing is that, for example, if he had a bike or a car and he was, let's say bought from Maruti or from Bajaj or whatever, and if he's going and servicing it in Bangalore, let's say he's moved out of Delhi and kind of go to Bangalore and he's getting it serviced in Bangalore, these data also gets picked up. Okay, because centrally, most of the automobile companies have aligned to the lending companies primarily because a whole lot of automobiles are sold on loans, right? So they better align. So that's the reason I think they're also giving out data.
Yeah.
I'm told that the government is also giving out data for the gas. Gas. If you have a gas cylinder.
Yeah.
So we are trying to kind of find that out. And if you change your homes and you go, the normal tendency is that. A normal tendency is that you typically give, you surrender your gas cylinder, and then you, go back and reclaim it from wherever you are going, stationing. So if you're going to Bangalore and you kind of go to the nearest agency and if you're going to get that cylinder back, right? So that data has also been thrown out. So you get to exactly know where he's living now, okay? Because cylinder reaches your home, right? So now you can have the second day you can have the collection guy knocking your door. So it's going to be very, very difficult as we go along. Okay.
Yeah.
So we do a whole lot of stuff. We have women callers, trying to kind of get addresses of these people who are not borrowing, offering them a free credit card without interest or whatever, so they get fall for it, and they kind of give the address for the credit card to be sent for documents and all that. So I think it's going to be very difficult in another 2-3 years from now. It's even getting difficult now. Forget about 2-3 years to kind of take a loan from a platform like ours and run. It's very difficult to run. Okay, so you will get served the legal notice in 90 days if you don't pay us out. Chances are that you'll get the legal notice. So from that point of view, I think it is very, very tight. So those are the things that we did, during this COVID time. Answering your question.
Yeah, that answers my question, which means that there are so many other parameters which have been. And how are you addressing the supply side constraints? Being a two-way marketplace, I'm sure there will be some hiccup because sometimes the demand will spike. You will need to honor the demand, need to keep the borrower interested. Sometimes the supply can be more.
Yeah, so we are a classical, P2P or a classical marketplace. So we'll have the challenges on demand side and the supply side always, and this is not peculiar in current times only, right? So for that matter, you'll always have that. So for example, if you have, so we are an organization of boiling two oceans, and we have to navigate both these, two sides smartly. Otherwise, the business does not make sense.
Yeah.
So for example, if you're in a situation, for example, if COVID has created a situation where, let's say, you had supply side completely going away, okay? And the demand side standing tall, so you will be in a bad situation, right? Yeah. So you'll have a lot of dissonance among the customers. So thankfully, we as an organization have never had that problem. So maybe 3/4 of our money comes through EMI, which gets reinvested. 1/4 of the money which comes to us is the new money which the lenders.
Okay.
So that side has kind of stabilized. The new investment has not grown, but it is continuing to grow at the same level. But the EMI investments are continuously growing. Okay. So from that point of view, we don't have a supply side problem. So demand side, yes, because demand side. So that's the side which is dynamic. Okay. So if I tell you that I have
so many parameters, which means that the demand, the eligible demand will shrink.
Yes, eligibility demand will shrink. Also, you may want to decide, which one to put, which one to not put. Like, for example, like say 650 was the elimination, criteria before COVID. Today it's 700, right? So that's because the external world is not lending. So those sort of customers are coming to us. So my overall parameters of assessing a customer has gone up. Okay? By default, it's gone up because the others are not lending, right?
Yeah.
So I get to keep good customers. I have, good customers coming my way, and I will kind of make sure that my criteria of picking up those customers and kind of making them live is going to be kind of much stiffer. Now, the important thing to understand here is that if these customers take a journey and they are happy about this, believe me, they'll not go back, because this is an investment, or this is a lending experience where you're sitting in the comfort of your bedroom in shorts, without combed your hair, and you're getting money in your bank account.
Yeah, true.
Which is not the case when you are applying for a bank, right? So even if the verification guy comes, you have to kind of be properly dressed or whatever. So I think it's changed, from the time. So from that point of view, I think demand is the one which is dynamic, and it has to be managed and calibrated the way the market behaves, because supply side is constant. You give a good borrower to the lender, he will lap it up. You give a structured product to the lender, he will lap it up. But the moment this changes, the equation changes, you have to be very careful. So that's what our business is. We kind of manage both sides smartly.
Yeah. So I would tend to believe that you are also of the opinion that this COVID situation would, on balance, be net positive for this digital lending side of the business, or for P2P lenders in particular.
Yeah. So see, I'll tell you what. So COVID has many interesting impact, on various organizations. So for digital companies, I think it has been a blessing in disguise in a whole lot of way. Okay. If you see earlier, when the lockdown happened, the first few companies which moved off the block were, shopping companies and, hyper, the Swiggies and the Zomatos and all these guys, they moved out really fast. So you can look at the preparedness, look at the, construct of the business that they were able to kind of deliver food at your, gate or at your doorstep without touching or calling you or whatever, within I think 5-10 days of the lockdown. Okay. So they could do that primarily because of the construct of the business, right? And we saw a huge lift in terms of the people moving digital, right? So I'm told that close to 40% of people have moved digital to avail certain services, avail various things or whatever. Close to 13% of people have moved on mobile banking. So these are large numbers, right? So it's a great win for digital companies. And part of these folks who have got into digital arena will end up consuming credit also as a way of life. So
absolutely, they'll come to know about credit on the internet. That's primarily where they find credit.
So I've been talking a lot about the criteria, way, collection, all of that. I want to understand from you, what is your criteria? What is your criteria of shortlisting, let's say, a P2P lending company or a platform?
That's a very difficult one.
What is, and you don't have to be biased or anything, just because you're friends.
I'm
just want to understand, what is it that, distinctly we look at, in terms of finalizing or, proposing to your clients about, because at the end of the day, you're more loyal to your clients than to Faircent, right? So
absolutely, it has to be that way.
Yeah.
So, apart from the usual suspects, like the quality of management, which is not measurable, the stability of the top team. So I have observed that you are, besides both of you, there have been quite a few other management members who have been very much there from the beginning, even the product officer. Then the type of investors that have invested in you, their background, then the way you raised money. So I've been observing a lot of platforms besides Faircent, and as a matter of disclosure, I've been invested in few of them myself. So I've realized that the breadth of products. So let's come to products later. But first, I saw that this particular organization has been funded. So this was funded way back in 2015, even before this P2P business was regulated. So I think at that time, so you got license, I believe, in 2017, late 2017.
Yes.
Yeah, when RBI started regulating this business. So before that, you had raised money. You had followed up that investments from seed to Series A. Then the Series B happened in 2016. Again, the same investors participated. So this is sort of validation of the model, the business model. So you were more like a torchbearer of this industry, that how this has to be done. Then when we joined the platform, we saw that there are a lot of partnerships that you have done in terms of borrowing side. So you have a lot of partners, a lot of fintech companies which have a very small 7-day loans, a daily loan product, even a 3-month loan, 9-month. So lot of these partnerships would be so a lot of these products we can align and we can identify with our needs more appropriately. And then the final thing is, I mean, size, because for us to participate we need to have a certain size. So we can't be 10% or 20% of a platform. So we need from that point of view, I think my choices were limited.
Okay.
The platform can't be a small platform. We need at least something like a 50 crore, 100 crore a month disbursement in normal times.
Got it. Okay, interesting. And tell me, in any of your clients, when you interact with them, do you think that P2P lending is an opportunity for them to kind of give it back to the society, give it back to the country, help the micro SMEs to grow, henceforth grow the economy, grow the employment? All of that is all related, right? So do they talk?
I would think so. Although we never had this type of discussion with clients, but I personally could identify that most of my clients are pretty much successful financially. So they would want to be doing something which not only earns them a decent return, but also contributes back to the society. So as we mentioned in the beginning, that there has been huge credit gap in our country, especially for the SME. And after this reporting to CIBIL, which has been made mandatory even from the platform standpoint, this is a very different animal than a private lending product, which means that this is one way where you can contribute back to the society. Now there's another way of doing it, but which may not be feasible for everyone, is like you invest privately or you invest early stage. But for that you need to have a very sizable corpus. So it's much better to lend to small businesses at equity-like returns. So we consider this more like a venture capital return, because the other day I was discussing with one of my investors who had an exit. So his angel investor was expecting 17-18% returns on his investment. So we were I mean, I was a bit disoriented by that, because why would I expect an 18% return if I can get it in P2P, and that too by taking much lower risk? So why do I? So most of the early stage investments would also expect those kind of returns.
Okay, got it. Okay, so another follow-up questions, on that. Now, if they're not looking at, so if you never had a discussion on that, you don't have to kind of answer if you don't want to, but you would have invested your clients' money, maybe 100, 200, I don't know how many number of clients that you have exposed to peer-to-peer lending on a platform. But whatever that number is, what percentage of those clients do you think are unhappy with investment on us or on peer-to-peer lending?
I don't have that number. I think there might be a few, but I don't have that number.
So if you had to put a finger to that few, what percentage would that be? 1%, 2%, 5%?
I mean, less than 1%. Overall, we have a less than 1% attrition every year.
Okay. And how does that compare with, let's say, an equity investment?
So equity is a very different animal. So see, my client or my investor would never blame the equity markets. It's always me who will take the blame if you lose money. And if you make money, then I'm just fairly expecting him to give credit to me rather than giving credit to the market. And my job has been made easier because stock markets have not done anything for last 2, 3, 4, 5 years. So whatever time frame you look at. So based on that, we have been able to generate decent returns. We have been able to make a lot of money during this lockdown. So that way, I mean, there's a lot of positivity. So we come from a very different place, thankfully. So I had this slightly digressing from your question, but I had this discussion with various others in my type of business that why they should be doing P2P. And so I always tell them that you may either invest in P2P, either participate or not participate, but you can't afford not to know this. But that is going to be very dangerous. So
interesting.
Reason not to do it.
Yeah, I remember you mentioning sometime to me, you should have a reason for not investing in P2P.
Yeah.
If you don't have a reason and you're still not investing, then I think you're making a mistake. Something like that you mentioned, right? Can you just say that again? I can't find that exactly.
Yeah, that's true, because for a normal, so if I can use that term, for a normal millionaire, a normal crorepati, he can't participate into tomorrow's Flipkart, tomorrow's Swiggy, or tomorrow's Ola. So how else he can make without trading or without taking a lot of risk? How else he can make double-digit returns?
Yeah.
And no one, and you can at least make a start if the conviction level is low.
Yeah. True. True. So I'm kind of exhausted with my questions. I think it's been an hour that we've been chatting. It's wonderful. This can go on. So if you have any questions, you can ask. One maybe final question, then we can give it back to Suchi. I'm sure there are a lot of questions the users have. And the interesting thing that most of them are still stuck there. Nobody has moved out of the discussion. I think the users also kind of found it interesting. I think that's the reason we're all there.
Yeah. This is something is very peculiar about your way of answering questions. Is like asking questions. Is that most of the questions that you have asked me while we interact have also been more like answers to my questions. So I came here thinking that I'll be asking you about the demand supply mismatch, or I'll be asking you if there's any change in the analytics process, or have you made any specific changes to the recovery process. Most of them have been answered. The only area where we thought is that is the risk philosophy at its core changed?
See, I'll tell you, the risk philosophy of Faircent has always been to make returns for the lenders.
Yeah.
Okay? It has not been, this is the number of borrowers that I'm onboarding, and out of that only so much percentage has to kind of, not go back. So that's not the philosophy. The philosophy is that at the end of the day, lender should make money. If I'm putting a borrower at 36%, that borrower is definitely much riskier than a borrower who's at 12% or 14%, right?
Yeah.
So when I'm putting that 36% borrower, and in large number if I'm putting, it is important to understand that the diversification there has to be a larger number when you're a lender on the platform. Only then you'll make returns. If you're going to, let's say for example, in 12% you're putting $100, you're picking 100 borrowers and investing in $100. In the higher buckets, you have to kind of pick up maybe 500 borrowers with
to get that normal distribution.
$100. Only then it gets diversified. Then you make a little more money, pretty decent, because there the defaults are higher, right? So on the higher. So we kind of do that, as a philosophy. We make sure that the lenders do not invest more than, let's say, 500,000, 2,000 rupees, or maybe at best 3,000, 4,000 at the highest risk level, and the lowest risk level not more than 10,000 rupees. So we restrict that, as an organization, because nobody else does that, right? So we restrict borrowers. You're not supposed to invest more than, let's say, 500,000 rupees or whatever in a high risk borrower, and the lowest you can invest a max of 10,000 rupees. So that has always been a philosophy. And the other philosophy that we have is that please don't keep your money in the escrow account which is coming back. That's the dumbest thing that anybody can do, okay? Because that money is not yielding you anything, right? So this money coming back as EMI should be redeployed again quickly. Okay? So either you tell your portfolio manager where to invest, this can quickly go there, or you should make a mechanism by which this goes and auto invests itself, depending upon which way the auto invest is moving. For example, if you're invested, let's say you've put the auto invest more on the high risk, and most of the customers that you're getting is low risk, your money will not move. So similarly, if you have put your auto invest in low risk, and the medium risk customers are coming our way, the chances are that your money will not move. So you have to be smart enough to figure out, or at least talk to your portfolio manager to understand where exactly this demand is, and which sector, which risk type that more of the demand is, and move it on. So it's smarter to kind of move to any risk type than to kind of keep money in the escrow account, because that is not going to yield anything, right? So we see a lot of money coming back to us and not getting redeployed, and I think that's something we are very, very as a philosophy we want to kind of do that and push lenders to kind of do that, because it ties up to our philosophy of reinvesting and compounding your returns. Okay, that is the only way you can compound your returns. Otherwise, returns are going to be kind of a little lesser.
True.
And I think finally, the third philosophy as an organization is that it doesn't matter what's the kind of borrowers you are picking up. Okay, what really matters is that if he has a source of income, there are ways and means to kind of lend that particular borrower, provided you can get decent data. Yesterday I was on a conversation with Times Now. So there was a journalist who asked me a question: Are India digitally ready? Okay, do you think so many people have the wherewithal, intelligence, and education to kind of apply for a loan digitally. So my answer to that was, see, people don't have, that should not be the qualification for somebody to kind of get a loan. Simple,
Yeah.
right?
Okay.
So we do a lot to make sure that we reach to them. Okay, so there are ways and means to reach them. Okay, so there is one way that we did was to kind of tie with microfinance companies. Okay, so they are digitally, sound, but their customers aren't. But their model is
That's
that
the bridge between you and the borrower.
yes. So P2P Suite is there. They go pick up the borrowers, they kind of validate them, all of that. They bring the these borrowers and we fund them, right? So you have to create mechanisms and processes by which you are reaching out to the borrower rather than you're saying that the other borrower is not literate, right? So I think for us, if that small merchant or if a small farmer who's making some money out of a small area, remote area, if he's making money, genuinely making money, I think there is a way to lend. There is no way that we can say there is an interway to it. So you tie up with organizations. We have a lot of clients like this who are not digitally savvy, who are not don't know how to use and or whatever, but still end up getting loans from us.
We are reaching out to them. Yeah, true. And I must also add that I have been using this extensively, and this has been one of the better ways of investing in these times. Also because these are the borrowing partners which offer a lot of collection support, which means that there is less volatility in terms of recovery.
Yes. Because there's the these borrowers are captive borrowers to the organization. For example, let me give you an example. For example, Eco have a lot of merchants that have given these terminals, POS machine terminals to kind of do money transfer. Now they are doing crores of business with Eco. They cannot just get up one day and just decide to kind of leave just because they've taken a lakh of rupees from us, right? So the dependency of that lakh rupees is much lesser than the dependency of the organization I have with the principal.
So it's a smarter way of tying up.
Yeah, smarter way to drive. Yeah. So we look at that and do it. Yeah, right. So I think we have kind of overshot the time. Another. So Suchi, over to you.
Thank you so much, Vinay, and thank you, Mr. Kulkarni. It was extremely enlightening, and the fact that we haven't had many attendees leaving this during this whole 1 hour reflects on how interesting this discussion was. Just before I take up the questions, I'd like to also thank, because we just realized that Mr. Satish Marathe, he is director with the Central Board of Reserve Bank of India. He's also one of the attendees. And I just wanted to take a minute to thank him for joining in and listening to this entire discussion throughout the 1 hour period. And it's really nice to have him. It's very encouraging to have him here. And
thank you so much, sir.
Yeah.
Thank you so much, sir. Thank you very much.
Thank you, sir, for being here.
And going forward to the question and answers, there are lots and lots of questions and answers out there, but I'll try to combine them and try to ask some questions together so that there's not much time that we take on this. One of the questions that I think both of you could answer, and maybe we could start with Mr. Kulkarni, is from Mr. Sri Raman. He wants to know is that how do we change the mentality of the Indian saving pattern? So I'm presuming that he's a partner and he's trying to understand how he can convince his clients more. Okay. And he's saying that they are still very highly dependent on deposits with banks or are looking at gold and real estate, while mutual funds have been in this country for so long. There is still a need to create awareness, and so how will we be able to push P2P industry, which is still a growing industry, still in its nascent form, with the Indian investor who has this mindset of going for a much more safer revenue? So I think it's a very interesting question, which both of you should answer. So Mr. Kulkarni, could you start with? We'll start with you.
So it's a very relevant question in these times. Although we never had this question in our practice, but it's very relevant. I'll tell you where today's environment is going to be a bit helpful is that the competition from FDs is going to be much less, because I don't see, looking at the macro, that we'll have a 7-8% interest rates anytime soon. In fact, we might well be in a structural decline in interest rates, which means that the interest rate. Also, one needs to mention the credit of this goes to the work done by RBI between 2014 to 16 specifically, where we have finally in some way conquered inflation. So now we have, for the longest time since the independence of this country, a positive real rate of return, which means that this positive real rate of return makes entire fixed income much more attractive than equity. I'm not trying to desell equity, but equity is a very specialist game. It's not for everyone. But entire fixed income, within that, P2P should be looked at as a subset of fixed income. Now, within that, if you can pick the blue chip borrowers, if you can pick the AAA equivalent of corporate debt, and if you can make 10%, I think that should be attractive enough for any informed investor. And the other reasons we have already discussed, which means the data science back, the ML, the deep learning that goes behind the recovery. But this very parameter that without taking too much of risk, I think one more thing is that not something which is in your hands, but which we can ask the regulator to give some tax breaks for this investment. Because we already discussed that this money is directly going into the economy. So that can again make the case a bit more simple.
Yeah, I was about to kind of, point that. So my reaction to that question would be, lending is, I think, the second oldest profession in the world. So nobody needs to sell that, right? Everybody knows to lend, and everybody knows to make money out of lending. So earning interest is a very old. Since the time currency has been introduced, I think lending has been introduced. But having said that, Indians understand three asset classes very clearly, right? Without any confusion. One is real estate, second is gold, and third is Byaj. Okay, that's the reason a lot of money lending and a lot of this thing happen in this country. Okay, they may be at the other side of the, they may be at the other side of the story, but the lending is per se, you don't need to kind of really sell.
Yeah.
So fundamentally, if you have any block in your mind in terms of P2P as an investment, that's lending investment, I think the sales is very easy. Sales is not very difficult. Is what with our experiences and our partners' experiences. I think the important thing is to kind of you need to be convinced about it whether it makes sense or not, right? So as a partner or as a lender yourself. The other thing, as Mr. Kulkarni pointed out, UK had a precedence where anybody who's investing in these platforms, especially towards micro SMEs, okay, the interest income that you make out of that is going to be tax-free, okay, and that's the law they passed 3 years back. Okay, yeah. We are also trying to kind of do that in India, all right. Trying to kind of talk to the government bodies and trying to kind of impress. We've written to Finance Ministry, Commerce Ministry, all of that we've written to, right? So they like the idea, okay? It's a question of time. In a couple of years, this will come, right? We don't need after that any, canvassing, any advertising or nothing of that for P2P. Everybody in this country will get to know that you should invest in P2P for tax breaks, which means that if you have any loss with respect to your investment that you've done, you can, also settle that from your total income that you've raised in that financial year. So it gets adjusted, the losses get adjusted, and the income gets tax free. So that's the way it works in UK. So I think then the entire country will get to know about it. So you don't really have all of them who have money, at least will get to know about it. You need to be poised, at least from that point of view, that you've gone out to all your customers and spoken about it. Because that's crucial, that's important, because if somebody else talks to your customer, chances are he'll go and work with him rather than working with you for P2P. That's why I keep respecting, I keep kind of telling Mr. Saurabh, Mr. Kulkarni is the Junjunwala of P2P lending. I keep referring that to my colleagues internally, that he's a Junjunwala of P2P lending. So that's exactly what you have to be as a player, if you are looking at it long.
Okay, so the next question, this is for you, Mr. Kulkarni. So there is a question which says that non-convertible debentures, they are secured and they are delivering up to 10% returns. So why should one go for P2P when compared to something that is delivering good returns and are secured?
Yeah, so because secured against what? Whenever you are dealing with a secured investment, it's secured against the assets of that company. Most of the times, the assets lose value as the company goes down. So when Kingfisher went down, most of the security was in form of its own leases, its own brand, which had to be written off. When Diwan Housing went down, most of the money, so pardon me for taking names, because otherwise we won't be able to address this question properly. So when Diwan went down, most of the assets were not there. which were supposed to be there. And how do you as an individual lender know whether it is there? And who is the trustee, and how do you monitor that those assets? So unless you're a large private equity fund, large vulture fund, large distress asset investor, for him that's a relevant question. That whether he should be investing in P2P and a pool of P2P loans, or whether he should be investing in a secured loan, because he has ways. He knows his way around the laws of that particular country. So we have hedge funds in US which are taking countries like Argentina to court, which are taking countries, I mean these jurisdictions like Costa Rica to task, and they are claiming their money back through the taxation receipts of those countries. So they know the treaties to which those countries are part. An individual investor doesn't have that sophistication. So as Vinay pointed out, that they need to rely on the fact that the average borrower is honest.
Yeah. So there's another point. There's another point.
Lot of borrowers, your money is being diversified, which means that the same 10% is not comparable.
Yeah.
This 10% is less or almost unlikely to break, or this principle is almost unlikely to break, whereas that 10% is a 10% for taking extra risk. So one quick example I'll give. Before ILFS crisis, ILFS bonds had some 60-70 basis points premium to AAA, which means that market knew something. So rational investors should have noticed that why should you be buying ILFS at 7? So why are the investors demanding that 70 paisa extra? Those are institutional investors. So for them, it's just a model. It's not their own money. But when it's your own money, you better have more conviction in the, so because it's not the collateral. So I would answer this question a little bit differently. Is like I would want to lend to a Shaparji Palanji, again taking names, with TCS as a collateral. That will be safer than P2P. Because even if Shaparji Palanji were to go down, unfortunately, my TCS shares are not going to go down because both two events are uncorrelated. Or a loan to Cafe Day, which was being given by most of the AMCs when we did that due diligence, when we invested in few AMC debt funds, they had secured that exposure against Mindtree shares. Now that will be a good example of secured. But this example is like you are trying to compare a secured NCD secured against the assets of the big company, which might fail. And should that happen, your entire money is gone.
Yeah. So I have a view on that. So a small view on that. So I think very valid points, which Mr. Kulkarni has brought out. I think the other way to look at it is that at the end of the day, the money that you deposit in the bank or the bonds or whatever that you're going to park your money with, all these fund houses, all these, is chasing some kind of an asset or chasing some kind of a business. So eventually it's getting, it's being utilized to lend, right? So on one side, you are looking at balance sheets of organizations to make equity investment. On the other side, you're looking at these bonds to kind of invest without any information about where this is going, complete non-transparency, right? So here's what this platform provides, P2P platform. The transparency at which you get to see the information of the borrower is unbelievable, right? So for example, when you use an Uber, you exactly know where your driver is, how long it's going to take to come, how much trips he has taken, what his name, his number, all of that you get to know. That is just a small information that you see, right? You come onto a P2P platform, you get to see everything inside out of that guy. Okay? His personal information, his financial information, his bureau information, his verification information, bank statement analysis. So you get that kind of transparency. Now you cannot go wrong with that kind of transparency. You can get to know that this is the guy that you are investing. So there is nothing beyond that. An organization taking the money or whatever, the banks taking the money, they really don't know where they're parking the money, right? Or what they're doing with that money. Yes Bank is a classic example. Okay? They really don't know, what are they doing with the money. So as long as, the new generation, people want transparency. They want user experience or people experience to kind of believe in certain things. And that is the reason these organizations like Amazon, Flipkart, Ola, Uber, they become so big because of the huge transparency they provide on both sides. I think that's a very, very important point.
Right.
Yeah.
I think that was a very interesting question also, because it can clarify a lot of doubts, a lot of other questions that have been coming in. I'll like to club questions from Mr. Thomas and Mr. Sudhir Kothari and ask Vinay. So basically, with what has happened with COVID, with the moratorium being extended, with the NPAs being expected to increase in the lending sector, What is your expectations for the P2P sector in terms of industry size and forecasted growth rate for the next few years? And how do you compare this with what's happening in the developed markets?
See, this is as I said, this is a blessing in disguise for organization like ours. This is from here on is going to explode. Okay, so we are getting a lot of interest from various sectors. Okay, so it's not just about having lots and lots of participation from lenders, individual lenders. We are getting a lot, and so there are 3-4 things that we're trying to attempt to make this an organization which is a pure retail player. Okay, one is that large number of lenders are participating, right? The other is a large number of borrowers are participating. The other thing that we are doing is that we are tying up with a lot of organizations to get their borrowers. So that conversation is kind of happening a lot now. Okay, earlier it was a little lesser than what it is now. So a whole lot of organizations of repute, organizations like Samsung, Fino, large organizations are talking to us to kind of can we fund their borrowers? Okay, MobiQuick, so large organizations, right? On this side, we have on the lending side, we have again, a lot of tie-ups happening with large organizations. Mr. Kulkarni is a classic example. Okay, similarly, we're getting a lot of interest from the lending side to kind of tie up for these asset class. Okay, so clearly looks like this is going to explode in the next, at least for us, for our organization, it's going to explode in the next 2-3 years. I think the important thing to remember is that, as Mr. Kulkarni pointed out, you don't have to compare it with a US or a UK or any of those, right? Because the dynamics are completely different. We could have a completely different story, right? UK credit card penetration is 60%, right? India credit card penetration is 3%. Okay, so there is a huge difference. So there are certain things, if they fall in place. For example, I was talking about the tax break. You will see a completely different picture of this industry. Completely different picture. So I think some conversation is happening in the government on. There was a fintech report which was tabled last year in September October quarter. In the month of September, that Mudra loans should move to P2P lending platforms, right? So it should kind of go through that because they want the transparency. Today, what the government is doing is they're putting out this money through microfinance, and some of the banks, and they don't get that visibility that they need, right? So a platform like this provides the visibility, and this is exactly what happened in the UK. Okay, government banks are today participating on peer-to-peer lending platforms. These decisions, right? A large decision like this. Now, this decision has been taken. It's just that the government takes its own time to kind of get to actually participating on these platforms. But the decision has been taken that it has to kind of go to P2P platforms, right? So these kind of things is what going to, and we are always, we are in relationship with SIDBI. SIDBI gives us a lot of borrowers. It's a question of just extending the other arm and saying that, can we have some money also coming from you? I think, you will see a completely different picture, in another maybe 2-3 years from now.
That's right. Actually, the COVID loans that are being disbursed by the UK government are going through RateSetter and other similar platforms in UK. So, and this has just happened in the last 2-3 months. Yeah. And so I think we can really hope for this happening in India very soon with Mudra participation to be there. Yeah. Okay, I think we are at the fag end of the questionnaires now. One last question to Mr. Kulkarni. This is, sir, what is the probability that an IFA will accommodate P2P as an asset allocation or short-term parking into his or her client's portfolio in the next few years?
I think that's going to happen. I would encourage this person to get in touch with me, but this is going to happen. He will have to do it because there's no other asset class which an IFA is dealing with today. I don't know the size of this IFA, but it applies to most of the IFAs. There's no other asset class which an IFA is dealing with today where there is any amount of technology apart from giving out reports. There's any amount of technology, any amount of data science which is being used. So how do you plan for the finances, for the retirement, or for any other goals of your investor without that technology being embedded in your own process? And P2P maybe just, in my opinion, P2P is a subset of digital lending, and digital lending is a subset of fintech. But this is his journey towards tech. Now we have seen what has happened with hedge funds in US. So it was initially the hedge funds which disseminated the mutual fund crowd, and now within the hedge fund, the quants are disseminating the non-quants. So this is happening even with the mutual funds also. So what is the amount of data? What is the amount of data that goes into picking a debt paper? And then there's a lot of furor around certain debt fund imploding, certain paper imploding. What is the amount of research that goes into it? It's just a credit rating or some internal rating. Some 10, 12 analysts trying to rate particular company based on the audited reports, and then compare that. So it's not comparing like to likes. We are much more sophisticated. And again, as I said, you must have a reason not to have this. Now, short term, I'm not very sure that how much short term does it mean, but we do have products between 3 to 6 months also in P2P, but the returns will be not much over there. So I think 1 to 3 years will be an ideal time horizon.
Yeah.
Okay. So just before we move towards the ending, I'd like to run one more poll. So I hope everybody is excited to answer this question. It will be on your screen, and you have about 30 seconds to just answer this question quickly. So this is there now on your screens.
This is a leading question, huh?
Very leading. I haven't given much option or choice to anybody on this. You have to do it. I mean, not after, if you don't invest in P2P after this session, when will you? So it's only a matter of whether it's going to be immediately or in the near future.
True.
So interesting. We do hope to see a lot more investments coming in, with about 70% people saying that they will be doing it very soon, and about more than 30% saying it's going to be immediate. So as soon as this session is over, we'll see some big investments coming in.
So Sushi, I just wanted to kind of point out to one of the comments that one of the participants has put out, Anant Krishna Iyengar. Interesting.
Yes.
Okay. He says that I was particularly impressed when an auto rickshaw driver was funded 50,000 rupees after due diligence, which otherwise you couldn't have got. Okay?
That's true.
Now these are the statements which inspire us. Yeah. Okay. I also had this. When I was taking a journey in Bombay, I think in a cab fellow, and he told me that he has taken money from Faircent, and I was quite, and I didn't tell him that I'm the founder of the Faircent. I just generally asked, "Kaisa hota hai, kya hota hai," and all that. He told me, and it was pretty much the same way, what this gentleman has, outlined here. So I think, so this is how we are trying to touch India. This is how we, and it is, I think, lenders like you who have to invest for India, invest for people who are Indians, who are wanting to kind of make a living. And it's a question of, so what I keep saying is that you don't have to put your money in just, one or two of them. Put your money in at least, 200 to 500, borrowers, and put a little bit amount, a substantial amount of 5 lakh rupees at least, only then it will start to make sense. If you're going to put a small amount of 50,000 rupees, and it's not going to make sense. Okay, please don't do otherwise. There's no people doing it only, because this will only make sense because the diversification has to happen at a level. 200, 300 borrowers have to have. They have to. Mr. Kulkarni will answer that question more beautifully, I think. I think that should be there. Otherwise, it doesn't make sense, right, sir?
And as time progresses, the portfolio size grows, which further reduces the risk.
Yeah.
Because you keep on reinvesting the returns.
Yeah, that's actually something that our analytic reports has shown time and again, that the people who have invested more amount of money on the platform and diversified it by investing in more number of loans are earning much higher yield, really, and they're all in positive yields.
Also, the volatility completely goes away.
And stayed put for 3+ years.
Completely goes away.
Yeah,
volatility is a lot when you're starting out. It kind of goes away because the more number of borrowers invest, because default percentage is a small percentage, right? That's how banks also operate, right? On the retail play, I'm saying. In large number of people they give out loans to, and some of them go bad, but because of the overall number of people that they give out to, they make money. So that's exactly how you guys have to do it.
No, what strikes me is that there is never any interest from any PE fund, any professional investor to buy a corporate loan book. They will always want to buy a car loan book. They will always want to buy a home loan book or a personal loan book or a credit card book.
Retail.
That it's common sense that you lend to retail and you are going to be okay. The problem is execution. How do you do it? And this is where technology comes into picture. So no one needs to be convinced that if you are lending to thousands of borrowers, even the professional investors, that you are going to be okay and you are going to make better risk-adjusted returns. The challenge is how do you do that in a particular time frame without incurring too much cost? So which is where the unit economics has to make sense for a normal bank.
Yeah, absolutely.
Yeah. So this is where the
Mr. Kulkarni, wonderful having you. I think it's always pleasure to kind of hear from you, especially analogy of the way you look at other different investment class. From that point of view, we are just novice. The way you look at it is completely different. That the example that you give about Shrapanji and Tata, it was a brilliant one. So I think so those are the things that we pick up when we meet you. So it's interesting. Thank you so much for coming and sharing your wisdom with us and time with us. Look forward to kind of meeting you soon. So I don't know when that is going to happen. I don't know what's happening at your end in terms of whether you are traveling or not. So we have to kind of more or less.
So I think Mr. Kulkarni's screen has got frozen. So thank you so much. Thank you all to our experts for their valuable insights, and to a wonderful audience. Amazing session. We hope we have managed to clarify all your doubts, and will help you maximize returns from your P2P investments. Feel free to write to us or contact your relationship manager in case of any further questions. Thank you and have a good day.
Thank you so much. Thank you, guys.